Thank you. It's a pleasure to be here. I apologize for being delayed. You know, the other day I was feeling very blessed. I'm a risk manager. Well, I had a risky experience that you might have heard about, this big auto accident on I-78 with fire and everything. It happened right in front of me. A split second earlier, I would have been dead, but avoided that today. I got a flat tire, so, you know, it goes all different ways. But anyway, I do want to talk about risk management, and my perspective on climate is that of a risk manager and an economist, and I think it provides a great context for the panel. The title of the talk is The Price of Climate Risk. What you learn as a risk manager, and I certainly learned this at Goldman Sachs, is that risk management is not about minimizing risk. Risk management is about getting paid for the risks that you take and hedging the risks that you don't want to take, and that's what leads to successful investing as well. And so it's really the issue that we want to face here with climate is what's the right price? What are the right incentives to reduce emissions? Of course we should reduce emissions. It's a risk management problem. Actually, that auto accident is a great way to frame it. We have a risk we see in front of us. I saw this tanker out of control heading straight at me with 9,000 gallons of gasoline, so I slammed on the brakes. I wanted to minimize the risk. That's what we should be doing with respect to climate. We should be slamming on the brakes, and the only question is how hard. Now, the price of emissions and the future path of emissions is what is going to affect the valuation of assets that investors have in their portfolio. So what you want to think about is what's the right price for emissions? What is that path going to look like? Now, I've written about this quite a bit. The first paper I wrote was for a publication called Regulation, published by the Cato Institute. That used to be called the Koch Institute. And, I had an audience in mind. I want the, conservative side of the political spectrum to understand the only issue here is what's the right price for emissions. Sadly, the guy who published this got fired. They weren't particularly happy about the message, but that message is getting through. And we're at a tipping point in public understanding of this globally, frankly, and it will happen soon. So we will price emissions. That's really not the issue. The issue is how high do we have to price emissions? We often talk about this carbon budget. And what the carbon budget refers to is the fact that we've already used up most of the capacity of the atmosphere to safely absorb emissions. There's a limited amount left, and it's a tiny fraction of what we're showing here, the limited budget. I don't know if this has I don't think I have a pointer, but that 565 is the remaining budget. And what you see on those tall bars next to it to the right are the amount of carbon in what are called proven reserves, not to mention additional reserves, but proven reserves of coal, coal plus oil, and coal plus oil plus gas. So what you can see is the main contributor is future coal. Coal is the dirtiest source of energy, and we can't use up all that. That's not going to happen. We're going to not use up all those proven reserves, and we call those that we aren't going to use stranded assets. They're not going to be burned. They're not going to be paid for. So they're sitting on balance sheets right now as if we're going to use them. Why aren't we going to use them? How do we know what we're going to do? We don't know what the future will bring. What we do know is we're going to price emissions, and then we'll figure out. I don't know if the appropriate technology is going to be nuclear or wind or solar or carbon capture. If I had to bet, it would be carbon capture. But I don't have to bet. As an economist, I just know that we have to create appropriate incentives, and that will develop the technology that will solve this problem, and it will be solved. Now, what's the right price? Well, interestingly, it's a difficult asset pricing problem. And what makes it a little bit difficult is it's not an insurance problem. When you price insurance risk, you can diversify across lots of outcomes like houses or even lives. Those are insurance contracts where the insurer will provide you a price for that risk, which is equal to the expected damage. It's the expected because it's a diversifiable risk. But investors know there's two kinds of risk. There's diversifiable risk and non-diversifiable risk. Climate risk is a non-diversifiable risk, which means you don't price it at the expected damage, You price it at a risk premium above the expected damages. And investors, we know something about risk premia, and in particular, it's not my individual risk aversion that determines the price. It's societal risk aversion. And we observe societal risk aversion really in the equity risk premium. That's our clearest source of measurement of societal risk aversion. And what it tells us, economists have known this for several decades, is society in pricing non-diversifiable risk is incredibly risk averse. So the risk premium that's required for climate risk is a combination of what's the actual risk, science tells us that, and how risk averse is society. And economics tells us that. And basically what we know is the combination means both higher risk and higher risk aversion mean a higher price for emissions. And so I guess that's what I say here. And so what does that mean? Well, when we think about risk, we have to think about the full range of outcomes. That's what it means. It's not the middle, the expected value. Most economists, frankly, and people who have thought about this are still focused on the expected outcome. What do we expect climate risk to do? That's not enough. We have to think about the full range of potential outcomes. And frankly, scientists today are much more concerned about the worst case scenario. You'll hear them talk about tipping points, nonlinearities, irreversible changes, basically some path that we don't know about, which gets out of control. Maybe it's the methane hydrates that are under the Arctic that right now are frozen. That Arctic ice is gone. The darker color of the water is going to absorb more heat. It's going to warm up. It's already starting to bubble up. We don't know what that means. And that's just one pathway. It's not that I have to tell you exactly what happens. No one knows. Scientists don't know. Ironically, historically, the deniers of climate have been pushing on scientists and saying there's so much uncertainty in the science. And the scientists have been, no, this is real. They're sort of pushed back in a corner, and they're trying to minimize the perceived uncertainty of the science. Well, that's over. The truth is there's a lot of uncertainty. Of course there is. We've never done this experiment. We don't know what happens as we heat up the ocean. We know some of the things. We know it's going to raise sea level. We know we have some idea. But basically we're doing an experiment, and what the scientists are saying very loudly now, they are screaming, we don't know what's going to happen. There could be very bad outcomes. We're not saying there will be. We're saying there could be. This is a 9,000-gallon tanker coming at you out of control. It's time to slam on the brakes. Okay? Well, I should maybe tell you why I put this picture up there. You may recognize this. This was a train accident that occurred in New York a couple of years ago. The driver, he lost concentration or something. He was going too fast, down the Hudson. Nice long straightaway, followed by, a downhill, and then a sharp curve. We don't know if there's a sharp curve up ahead. We don't know what the safe speed is. Think about two scenarios. Scenario A is you've been down this path before 100 times. You know exactly what the speed of going around that curve is safely. You know where to start braking. How do you brake? What's the time path of your braking? You ease onto the brake. You start with plenty of time. You know how long it's going to take. You ease onto the brake. And at the corner, that's when your maximum braking is. You know exactly what you're going to have to do to get around that curve safely. That's how economists and scientists have historically been thinking about climate risk. It doesn't take uncertainty into account. That's if you had the expected value. I've been down here 1,000 times. Now what happens if you don't know? What if it's the first time that you've been down that track, you don't know how fast that you can go around that curve safely, and all of a sudden you realize, oh my God, I might be going too fast. You hit the brake hard. You hit it hard enough that you're very confident that you'll get around that curve safely. Well, that's what we have to do as a global society. We have to hit the brake hard enough that we know we're going to get around that curve safely. It's all about pricing this risk appropriately, and that's a higher price than economists have historically recognized. And you want to think about the full time path. Here are two examples of what those time paths might look like with a less risk-averse society and a more risk-averse society. The more risk-averse you are, the higher you price risk immediately, that is, today, and then maybe you expect to have a lower price going forward. Those forward prices, 2075, 2100, and so on, those are very dependent on unknown technologies. And so what we're basically saying is likely the price will come down because we're going to develop technologies that will solve this problem. And we do have some time, hopefully. The risk is we don't know what time we have. I like the concept time compression. I saw it in my life in 2007 when the quant space melted down. I thought I was going to have months to get out of positions. Turned out it was going to be days. That's what happens when you cross a tipping point and there's a nonlinearity. If we have plenty of time, when people talk about climate risk, they emphasize sea level rise. We think it's going to be a couple of feet over the next 100 years. If that's the worst case, that's not a catastrophe. We can deal with that. The worst case is a sequence of events that gets out of control that leads to a tipping point, time compression, and we can't solve it. And frankly, that's a possibility. That's what we're dealing with. Catastrophic risk is what drives the price of risk appropriately today. So you got, and I'm a risk manager. People talk about catastrophic risk. By the way, they have no clue. They think a hurricane that destroys the Philippines or Katrina or something is a catastrophe. We're talking about a global breakdown of, ecosystems, a tremendous decline in the quality of life for humans forever. That's what we're talking about. It's an existential risk. I don't think catastrophe quite covers it. And, when I stand up here and say that, people think, oh my God, he's an alarmist. I'm not an alarmist. I'm a risk manager. That's what risk managers get paid to think about. What's the worst case scenario? And the worst case scenario here, no one knows. So I'm just telling you, we've got to price this risk. We will price this risk, and it's going to happen faster than people expect. And that's what you as investors have to recognize. Okay? And here's just an example of what the fossil fuel companies are telling you. I've been involved with an engagement with Exxon and Shell, and they came back with a report. Exxon did. This is from their report, but the other oil companies are saying the same things, which is basically we don't have stranded assets. The government's not going to price emissions. It's the price path, is going to look like these curves going up exponentially. There is so much wrong with this. I like to joke, the old Sinclair Upton quote, it's hard for a man to understand something that's, how does that go? When his salary depends on it. It's hard for a man to understand something when his salary depends on his not understanding it, okay? Well, it's hard for these oil companies to understand economic approaches to risk management of climate risk when their asset values depend on their not understanding it. So they're basically saying, don't worry, our values won't decline because governments are not going to price emissions. It's going to look, first of all, this green line, 450 ppm, which parts per million, which is consistent with 2 degrees centigrade change, that's much too expensive. Now, why is it too expensive? Well, because it looks like this, and you get to 44% of median income. No one's going to pay that, right? Well, that's ridiculous. There's so much ridiculous about this. First of all, the appropriate path doesn't look like this. It's not the slow increase when you know what's going to happen. It's the slam on the brakes scenario because of the risk. That's number one. Number two, where we get to is a function of future technology. We're not going to price emissions at $1,000 a ton. Today, you could suck emissions out of the atmosphere, most people think, for something less than $1,000 a ton. You won't do that because it's a lot cheaper just not to put them in. The appropriate price might be $50 or $80 or $100. It's not $1,000 today. It certainly won't be $1,000. If it ever got to $500, we'd just suck it all out of the atmosphere because you can do that at $500 a ton. And then, it's 44% of income in 2100 if income doesn't change. Well, that's a little extreme assumption. And the third thing is, by the way, everyone's consuming the same amount of carbon emissions at 2100 at $1,000 a ton, even though it's priced at $1,000 a ton. There's so much wrong with this. They're having a brain something. And so, you know, they say, well, maybe we'll get to 650. And at 650, when it's not so expensive, none of our assets are stranded. Trust me, their assets are stranded, but it's not really the oil companies. It's hard to say. They may be able to pivot to natural gas, and I think natural gas is going to be a big part of the solution. It's the coal companies and the expensive sources of oil, like tar sands, like deep sea oil drilling. That's just not going to happen. We're not going to burn all that coal. We're not going to burn all that oil. I think Exxon will remain in business, but their valuation, I think it is suspect. But in the meantime, as investors, don't focus on fossil fuels. Focus on stranded assets. And stranded assets are coal, tar sands, the expensive sources of oil. And those are the things that just aren't going to come out of the ground. You know, if you're Saudi Arabia, you've got a lot of oil that you can pump out at 25, dollars a barrel or whatever. That we will use. But, you know, the expensive sources, no, we're not going to get to those. Now, how is this going to happen? Well, I don't know how it's going to happen, but what we got to think about is it's not the actual pricing of emissions that causes stranded assets valuations to go down. It's increases in the expected path of pricing emissions. If you think emissions are going to price sooner and at higher levels than people currently expect, that means those valuations go down. So what I've shown here is this brown curve, which is the current forward curve. If you ask people what do they think, where do they think emissions are going to be priced, by the way, where does this start? It doesn't start at zero, and it doesn't start at a small positive number. You got to think about all the subsidies to fossil fuels globally. I just got back from Saudi Arabia last week. Gasoline there is $1 a gallon. You know, there's a big subsidy in Saudi Arabia, in Venezuela, in Iran, around the world. If you add up all those subsidies to fossil fuel consumption, the actual price and those are at 10 times, well, I don't know if they're 10 times, 6 times the International Energy Agency estimates, bigger than all of the global subsidies to, renewables and the minor pricing of emissions that you have in some venues like Europe, like California, around the world. So bottom line is when you take a broad view of this and say what are the global average incentives to reduce emissions, it's a negative number. We're subsidizing emissions at about $15 a ton. So think about it this way. Right now the foot globally is on the accelerator. We have to brake immediately. And the key insight, some people call this the Litterman model. There's no model here. There's an insight. The insight is we're not going to price emissions slowly over time. There is no reason to price emissions slowly over time. There is an insight, which is that when the appropriate price is here and the current price is down there, the appropriate path for pricing is an immediate jump. I learned that as a graduate student from Professor Herb Moehring at Minnesota. So if you want to call it an insight, the name is the Herb Moehring Insight. Prices, you don't smooth prices. There's no reason to smooth prices. Utility is a function of allocation of goods and services. If the appropriate price is here. Now, some people, you say, why is he going on about this? It's because a lot of people don't understand it, even economists. And what do they say? They say, well, you can't price emissions so quickly. We have all this installed capital. Coal-fired power plants, they're going to be, their valuations will be destroyed if you price emissions appropriately. No. That's not what destroys their valuations. What destroys their valuations is the externality of the emissions. That's real. That's today. The values are gone. The true value of those stranded assets is already destroyed. So what happens is the recognition will cause those false higher valuations today to come down to the true value. It's not that we're destroying value here. The value's already gone because of the true economic externality. So that's why I get agitated about this. And the question is, when and how will these expectations go from a smooth, slowly rising curve, or that exponential that you saw from Exxon, to the reality, which is an immediate jump to a level that will give us high confidence that we're going to avoid this collision, okay? And that, I think, is going to happen soon. So what does this recognition imply for investors? It's very simple. There's two things. Number one, portfolio construction. You want to hedge the risk of your stranded assets. And number two, governance. You want to make sure that the companies that you own are appropriately taking this into account. Now, the good news is this is all happening right now as we speak, and I can actually show it to you. I'm actually the head of the investment committee at the World Wildlife Fund. We have a small, endowment. You can imagine over a year ago, the directors of our board got very upset about what are we going to do? What are we going to do, Bob? We should do something with our portfolio. Should we be selling our fossil fuels? Should divestment, that's what everyone's talking about, should we be divesting? I said, no, we shouldn't be divesting. We should be recognizing the reality that emissions are going to be priced. That's a risk to our stranded assets. Let's hedge those stranded assets. We talked to our consultant. I don't think they mind if I say Cambridge is our consultant. They said, oh, it's very expensive, and we'll do a little analysis for you. They looked through our whole portfolio. We had 1% invested in coal and tar sands. It was tiny, but it wasn't us making those decisions. It was our external managers, private equity, hedge funds, external equity managers. They said, if you want to eliminate all that from your portfolio, it's going to cost you an arm and a leg. You're going to have to sell private equity. You're going to have to redeem from hedge funds. You're going to have to talk to your managers, et cetera. You don't want to do that. Okay, find a cheaper solution. What can we do? So we worked with them. We came up with, I think, a very creative solution. An index of coal stocks, oil sands, tar sands, and we created a very simple overlay, a derivative instrument, a total return swap, where we enter into a contract with a counterparty, Deutsche Bank. We pay them the total return on an index of stranded assets. They pay us the total return on the S&P. Now, I like this because it's so simple. What is this? It's an overlay. You don't touch your underlying portfolio. It's a bet, if you will. What's the bet? Stranded assets will underperform the market. I love that bet. Do you not think stranded assets are going to underperform the market going forward? So what does this bet do? It hedges your risk. It gives you a positive expected return. And if you're the World Wildlife Fund, it aligns your portfolio with your mission. Okay? We want to save the earth. We want to save these ecosystems. They're all threatened by climate risk. And as long as we own stranded assets, our portfolio is negatively impacted by our getting emissions priced. So now we've eliminated that inconsistency between the portfolio and our mission. Why wouldn't you do that? Everyone should be doing that. So that's number one, hedge your stranded assets. By the way, how's that done? Not bad, okay? And, some of my colleagues said, well, Bob, I hear you, but, and this is going back a year ago, they said coal is cheap now. Coal had underperformed the market by 60% over the previous 3 years. Well, as of last week, by the way, we had a really good day. You notice when we had the Republican election at Congress, coal rallied a little bit. It was a small rally, okay? Since then, now it's actually, this stranded assets total return swap is up over 30% this year. It's one of the best, bets, if you will, trades, how's that? Best trade I've done. 30%. And look, it's kind of accelerating. And I'll give you some color here. So we put this on at the beginning of the year. Stanford announced they were divesting of coal back in early May. And by the way, I was very involved in that. I've been talking to investors like Stanford, like Yale, like Harvard. They don't all listen, but Stanford listened, and they said we're going to divest their coal. The only thing I didn't like about it was they didn't mention stranded assets. Just underlined stranded assets. Why did you divest of coal? Well, we knew it was the right thing. That wasn't very helpful. Let's talk about because the emissions are going to be priced and because these are stranded assets. But it was a good decision. And, it looks to me like expectations of emissions pricing are accelerating. We could talk about what happened around here. That's when Yale announced that they were going to, they said, we're not going to divest of fossil fuel. The students were a little upset about that. But they also said our chief investment officer, David Swenson, is going to talk to our external managers. He wrote a letter to those external managers. We're going to publish that in the FAJ early next year. It's a great letter. And he basically said, look, climate change is real. It has consequences for all of our asset valuations. We want you, external managers, to take those into account. As far as I'm concerned, that's a much better outcome than saying we're going to divest of fossil fuels. We're going to recognize the reality of the pricing of emissions and clean up our portfolio. And you external managers, I want you to take that into account. Investors all over the world today are grappling with this issue. And, a lot of investors, I think, are cleaning up their portfolios, and that's why stranded assets are underperforming. And if you're a big investor, you want to get out before everyone else gets out. It's not like, I'll just get out. If you're World Wildlife Fund, you get out, you have no impact. If you're CalPERS and you realize it's time to get out, you're going to be getting out over some period of time, and you don't want to be too late. You want to be early in that. So that's what's going on. That's all good news. Lima, and what's going on, the agreement between the U.S. and China. I tell you, those long-term targets, to me, they're meaningless. The only thing that matters is what's the current incentive. Okay? Maybe they're meaningful in terms of changing expectations, but let's keep our eye on the ball. The question is, what's the current incentive to reduce emissions, and what are expectations of incentives to reduce emissions? And I think expectations are changing, and appropriately so. And the final thing I want to say is something about engagement. I advised Yale quite a bit in their decision process, and they have a great book. They call it the Ethical Investor, I think. It was a book they wrote years ago about what does it mean to be an ethical investor. And so I'm kind of trying to bring this full circle. They said, you don't want to divest, you want to engage. If you have a company that you own that's not doing the right thing, the right thing to do is not sell that company, it's to engage with that company. Now, I would add a little bit of complexity to that, okay? Because if I own a coal company, what am I going to tell them? Get into another business, your assets are worthless, there's not much to engage about. So there is a caveat to the engage versus divest, and the caveat is if you know there's an event that's going to affect the valuation, you have no obligation to hold on to that asset. You can sell that asset if you see that coming, okay? So divest of coal, but aviation is a very strategic engagement right now, and I encourage all of you. WWF is working with CalPERS, with Ceres, with investors around the world to engage with aviation. And what are we saying to aviation? We're saying science needs a seat at the table. And what are we talking about? Well, aviation has already agreed to create what they call a market-based measure to reduce emissions. That sounds terrific. The only thing is they haven't thought about where should we price it. Okay? They want to price it as low as possible. So their plan right now is to buy cheap offsets and credits and essentially, greenwash the whole issue and say, we've offset our emissions. That's not good enough. WWF has a seat at the table. We know what's going on because we don't have a vote, but we're engaged with aviation right now in something called ICAO, the International Civil Aviation Organization. By the way, they're dragging their feet as well. They don't really want to go forward, but they've promised to buy these offsets starting after 2020 if they don't otherwise hit their aspirational targets. I hate this idea, targets, ambition, aspirational BS. Okay? The issue is, what's the right price? You're creating a market-based measure. The way I like to call it, it's the first globally harmonized emissions price. This is a key benchmark. Where is it going to be set? Science should tell you where it should be set. It should be set at the appropriate level. Okay? Owners of aviation should be saying to the boards of aviation, and by the way, this is in aviation's interest. Why is that? Raising prices, taxing consumers, how can that be in your interest? Because aviation needs the capacity to emit emissions. The technology of flying is not going to change much over the next 50 years, and you can't use solar, you can't use wind, you can't use carbon capture, you can't burn hydrogen, it doesn't have enough energy per unit of weight, you're going to be burning fossil fuels. You need to emit emissions into the atmosphere, so that's a scarce resource that you need. When everyone on the ground has stopped using it, aviation needs it. Right now, that resource, the atmosphere's capacity to safely absorb emissions, is being wasted by society. So it absolutely is in aviation's interest, in the long-term interest, so we've got to engage as long-term investors with aviation to say, look, it's in your interest to lead the global effort to price emissions appropriately. Most people don't realize there should be one global price for emissions. As an economist, there's an appropriate price We don't want to set it at the lowest price possible. We don't want to see a slow policy ramp. We want to immediately price it at the appropriate level. Final note, scientists understand this. The IPCC synthesis report just came out about 3 weeks ago. Most people haven't paid a lot of attention to it. There's a little box in there that talks about the weakness of economist models. And there are a lot of weaknesses in economist models. I'm an economist. The scientists are right. What they said is those models don't take catastrophic risk into account. When I tell you the scientists are screaming, they are screaming if you know what to listen to. Those models don't adequately address the irreversibilities, the unknowns, the potential for these scenarios that I was talking about earlier. And what does that mean? That means that although the economist models tell you it might be a price of $40 a ton, it's really higher than that. You have to take that into account, and that caution raises the price. So scientists have really told us what we need to know. And frankly, my response to that to the scientists is, you've got to tell us probabilities. Don't tell us these things can happen. Is it 1 in a million? Is it 1 in 1,000? Do you have any idea? If you don't, that raises the price. So, but in order to get some sort of idea what the appropriate price is, you've got to give us a better idea what are the probabilities and how bad could it be. So that's kind of where we're at. But if you're an investor, it's time to get out of those stranded assets. And it's time to help us engage with the aviation industry and create one appropriate global price for emissions. Thank you.
Wow, Bob, thank you very much. That is the way to begin a morning on the carbon discussion. Bob is going to join the panel. If you have questions, we will take them in the format of the panel along with our other panelists. If I could invite them to come up and all take their seats. Just as an anecdote, I heard Bob speak a few months back in London to a small room of